This research is part of the ECB CHAMP cross-country project, which brings together central banks to study how monetary policy is transmitted across euro area countries using unaccredited data. So here's the core question we're asking. How do differences in lending practices structure across euro area affect the transmission of the ECB monetary policy? So we already know from the literature that lending practices across euro area vary significantly. But most studies stop at the mere classification between floating versus fixed rate loans. So what is missing often is a deeper look into how a loan is actually priced. And here, where our paper comes in, we introduce a new dimension, the maturity of the relevant risk-free rate. And this is important, but it actually determines which parts of the yield curve loan is exposed to, and that in turn affects how sensitive loan rates are to changes in ECB policy rate. So we use unaccredited data, nearly 7 million newly issued loans from January 2022 until December 2023. And our detailed descriptive analysis reveals a wide variation in lending practices across euro area countries. But structural factors such as loan type, firm size, sector only explain a small part of these differences. And that's our motivation to deeper in loan characteristics. So the mere classification to floating versus fixed rate loans misses a lot. The reference rates used to benchmark loans, as well their maturity structures, vary significantly across euro area countries. And these differences are actually important because they shape how loans respond to monetary policy. So we turn to our empirical strategy, where we decompose for each loan rate into two components. The first one is the relevant risk-free rate, and the second one is the loan premium, which is actually the margin over the reference rate. And we ask two key important questions. The first one is how much of the variation in lending rate changes between early 2022 until late 2023 is due to changes in risk-free rates versus changes in loan premium. And the second one is whether monetary pass-through depends on the maturity of the relevant risk-free rate. So here's what we find. Across all countries, rising risk-free rates were the main driver for higher lending rates. But, and this is actually important in our study, higher increase in risk-free rates doesn't always mean higher increase in lending rates. In most of the countries, banks offset these rising reference rates by compressing the loan premium. So this leads to a deeper conclusion. Loans priced off shorter-term rates show a stronger and faster pass-through. But this is only the mechanical part. Also, banks adjust loan premium actively by compressing when reference rates are increasing. And this smooths the transmission of the monetary tightening. Overall, the key takeaways is twofold. First, loan pricing design matters. The maturity of the reference rates are a key driver for monetary policy transmission. Second, banks do not just passively transmit policy. They also actively adjust loan premium. So policymakers should take into account this endogenous repricing when they assess the effectiveness and the stance of the monetary policy.